our live event. We're live. Awesome. Hey, everybody. Welcome to our weekly training. Today is a great day to learn about tax strategies, how to keep and grow your money. Every Wednesday, I come to you live with Building Wealth, live with me, David A. Perez. Now, if you like this content and you want more of it, please comment, please share, subscribe, do whatever you got to do to promote. Welcome to our weekly training. There you go. To promote this channel, because my goal is to impact 5 million people, and help them keep and grow their money. We're going to do that through tax strategies, investment strategies, and business strategies. And I use those things every day for myself. And I sometimes feel like I'm you, right? I feel like we connect. And so in today's episode, we're going to be talking about rental strategies. How do you buy and invest in rental real estate, and how do those strategies, and what strategies to take advantage of in order for you to maximize your tax savings so you can keep and grow your money. Are you all ready for this? Now, if you have questions along the journey, please put them in the chat. Now, if you want to watch this on YouTube, you may be watching this on Facebook right now, but go to YouTube so you can actually ask the questions. I am going to answer all those questions and so much more. So today, rental strategies, okay? So first off, what is a rental property? It's a property that you purchase, real estate primarily, that you would use for the servicing of or renting of a unit or a house to an individual who would pay you what we call rent. Now, are we using this camera or this one? Okay, my bad. What we call rent. Now, when you get rent, this is called income. So you call it rental income. Now, everybody gets, when you buy a property and you rent it to somebody, you get rental income. Now, rental income is taxable income, just to be clear. When you think about rental income, it's not tax-free. It is taxable. So what that means is you're supposed to pay taxes on it. However, since rental strategies come from real estate, we know from past videos, and because I've been doing this for a long time, that real estates, I don't know why I put it as, real estates has a tax advantage, right? The tax advantage is that you could not pay taxes on rental income. So let's talk about rental income, right? So there's several ways to get rental income. You can get it from a short-term rental, you can get it from a midterm rental, or a long-term rental. So short-term rental, STRs, are typically rentals that are like Airbnbs, typically averaging less than 7 days. Midterm, typically 30, 60, 90 days. Long-term, typically 12-month contracts. Now, each one of those has their tax advantages. However, I would tell you that right now, being that we're coming to the end of the year, we need to start planning, right? So when you get rental income, you get STR, short-term rental, or long-term rental. We'll just do short-term, long-term. This would be equaling 7 days or less. And this one is long-term, would just be 12 months, right? We could pretty much say more than 7 days. But for the sake of this conversation, this is what we do. Now, why am I sharing this with you? Well, number one, if you understand what a short-term rental is and a long-term rental is, there are different tax advantage strategies that you can take. We just have to be mindful of that. Without knowing this, you would probably buy it. Now, I think I should stop really quickly and just kind of lay it all out there, okay? I want to talk about real estate first. I think I'm getting too far into the strategies without planting the seeds of real estate. So first off, real estate, my favorite tax strategy. Why? It gives you 4 quadrants, right? We got number one, the appreciation. Every year, real estate goes up in value, which causes you to have a higher net worth. Number 2, every time your tenant makes a payment and you apply that payment towards the mortgage, you have now built more equity, which means the debt is being paid down. So the value versus what you owe grows. That's called equity. Number 3, there could be possible, and I say possible, opportunities for cash flow. Cash flow is the excess cash that comes in from a rental property in addition to what we would call principal and interest if you have a mortgage, insurance, and taxes. So if your insurance, principal, and interest and taxes equal, let's call it $1,500 a month, but every month you're getting $1,700, that $200 in addition, it's what you call cash flow. And the fourth benefit, the fourth quadrant benefit here, is going to be tax savings. Now, tax savings is the most common one that we talk about because most people will think, well, actually, that's a lie. number one is cash flow. Number two is tax savings. So we're always thinking cash flow, tax savings, cash flow, tax savings. And so when somebody buys a property, they're like, yeah, I'm going to get cash flow and I'm going to get tax benefits. So like, I got both of these things. The challenge here is understanding how this rental strategy works, because not always do those two things happen. There's certain criteria that you must meet, number one, and number two, the cash flow may not be there. So why don't we do this? Let's kind of focus on the cash flow thing, because this is rarely taught or rarely talked about, and I think it's one of the hardest things to really explain to someone, that the income from rental properties isn't always there. And so we're going to use I'm going to call it a $300,000 property that I'm going to turn into a rental. Okay. So I'm going to turn a $300,000 property into a rental. Now I'm going to need my trusty calculator here, because I'm not that smart, and I want to make sure that I give you the right numbers, right? So what I do, just for the sake of this conversation, what I do is I go find a mortgage calculator. Okay. Usually I find a mortgage calculator online. Google has one already built in. It's pretty accurate, not the best, but let's say I buy a $300,000 property. Okay. Now I'm going to put, because it's a rental or an investment, I'm going to multiply that times 20% down, because that's what it's going to cost. So I'm going to have to put $60,000 down. Okay. So my total investment in this property or my total balance on the property is going to be $240,000. So that's what I'm going to finance. So what I'm going to do is I'm going to take $240,000, and what I'm going to do is I'm going to put 30 years as my mortgage, because that's typically what you're going to get. And I'm going to put an interest rate of 9%, because that's typically what it is for properties that are in that are being rented out, rental property, investment properties there. Okay. So with that said, so at this times, so it's 240 at 30 years at 9%. Okay. My mortgage payment is $1,931. Okay. Now, I'm going to guess on this, just from the sake of the conversation, the taxes are probably somewhere around, I would say, $400 a month. That may sound aggressive, but in a nice neighborhood with 300,000 in Texas, it's going to be $400 a month. So we got 400, and I'm going to say my insurance is going to be about, Texas again, $300, right? So $300 a month. So here it is. Okay, so I got 1931. I could probably do this easy, but I always mess up now. Plus 700. 2631. Or 37, rather. This is what I would call my nut. That's what I got to get every single month in order for me to buy this property. Because if I can't get this in rental income, then I'll be negative. So if I can't rent this property for, let's call it $3,000 a month, guess what? I probably won't make any money. You see what I'm saying? I have to make this. So what if I could rent it for $2,700? Well, then I'm going to make, in this case, I'm going to make $63 a month in cash. That's called cash flow. But $63, is it worth it? I don't know. $63 on a yearly basis, right? We're looking at a whopping like $700 in in cash. Like, do I want to make $700 in cash and leave $60,000 in a property, plus be responsible for $2,637 every single month? If I don't have a tenant, I've got to pay that. See, when you're buying rental properties, nobody thinks like this or talks like this, just because it's not really understood how it works. That's why I don't believe real estate is always the best fit for someone, especially if they're getting into real estate for the first time and they're trying to do a rental strategy. Well, this may not make sense. Now, I'm using the Google calculator. To be honest with you, this seemed a little high to me, but I'm just following what they said. So 1931, $400 for taxes, $300 for insurance equals $2,637 at a $240,000 financed, 30 years at 9% interest rate. Now, 9 you may think is aggressive. I'm telling you, it's not. At today's market, when you're about 7 to 7.5 already, just as a normal buyer, add a point to a point and a half for the sake of this conversation, because we're using investment properties, and I'm putting 20% down, so I'm financing $240,000. So there's two ways to solve the equation, okay? Now, some people would say, well, David, could you rent it for $2,600 a month? I don't know. That seems pretty excessive for most markets, but it depends on your market. I would tell you in the market that I'm in, that's pretty high. $2,500 rents is not a typical thing in my neighborhood, but I'm just telling you it's pretty high. How do I get this to go down? This is where you actually, this is the lever, if you will. If there was a seesaw, this is the lever to move. So instead of coming in with 20%, you could go 30% or 40% or 50%. So I'm not saying that you need to have a ton of cash to get into deals, but it helps. Because if you could put 50% into the deal, now you're only going to finance 150,000, right? And if you finance 150,000, I'm just using simple math, guys. I'm playing around with numbers for you. 150. Okay, now my mortgage is $1,207, right? And if I add the 700 there, so it's basically $1,907. If I were to finance half of it, now I can rent it for $200 or $2,000, $2,500 and make $500 cash flow. That might make sense. Now, just sharing all this with you. And by the way, if you have questions, you're more than welcome to put them in the chat. Let me get some water. If you guys have questions, anybody have a question, by the way, any on these chats?
Yes, one on Facebook.
Go for it. What is it?
So I got hit with 34 this last year. Could I have used that money to invest in property or development? I think I've outgrown my CPA.
Okay, good question. Could you have invested in real estate to offset the tax situation? Yes, you could. Now, how much would you need to invest? How much did they say? 30,000? 34,000? I don't know your tax bracket, but I can make a guesstimation. So you're going to pay 34,000 in taxes, right? In taxes. Right? Now, to be able to offset 34,000 in taxes, you would have to have here this is not going to be that hard. I just can't do it backwards. I don't know how to do that. So 25% times 37%. Yeah, I'm right. To offset that, you would do 500,000 in a property, right? So you're going to put 500,000. Now, to buy a $500,000 property, you're going to have to put, 20% down, which is $100,000, right? So you're going to put 100,000 down. I'm only using this so you know how much cash. This is your down payment. You're going to put 100,000 into this. You're going to get 400,000. Oh shit. You're going to have 400,000 financed. That's just for the sake of the conversation. This has really no bearing on it, but I want you to know that you're going to use $100,000. Now, you invest $100,000 into this property, you get 500,000. Now, I'm going to assume that the land value of this thing is about 50,000. That's where you can't depreciate land. So I got 450,000. Usually on an annual basis, I'm going to put minus 50,000 for the land. Right? And that's 450. So we have 450,000 in an asset. Now, what I like to do is use a formula. The formula here is we want to accelerate the depreciation of this asset. The way we accelerate it is using a cost segregation study. Now, I'm not going to go into too much detail. I would just say that I could probably take 25% of this as a deduction in year one. So I multiply it times 25%. And so times 25%. I get 112,500, okay? Now, why is this important? Let's just assume your tax bracket is 30%. 30%. So your tax bracket's 30%. So if I save 112,500, I should get 30% of that in tax savings. So I move that times 30%. I save times 30%. Here's the savings. What did we say? 34,000? $33,750. This is the savings that would offset that. You'd have a $250 tax bill if we did that strategy right there. 250 bucks. I'm missing a few little things here. I'm not saying that I gave you a whole equation, but just so you know, this is pretty damn close. I mean, these are assumptions. I don't know what your tax bracket is or any of those things. Hope that helped them. Any other questions?
Should you set up a trust first, or can you set it up after the purchase?
Good question. Well, I'll just answer that. Look, just so you know, first off, a trust everybody should have. Revocable living trusts are great. They protect you in certain ways, which I guess really here's a way to think about it. First off, we don't want to get overly complex with trusts. We want to make sure that a trust is set up for the sake of keeping privacy and some control. Having a trust does not do anything to your taxes, just to be clear. Now, it could if there's specific types of trust, like an irrevocable trust, or maybe no, not even a land trust, charitable remainder trust. These are types of trusts that have tax implications. The majority of us, including myself, don't really need those until we're really, really wealthy. What you really want to have is just a revocable living trust that would own your assets. You can always set it up, even after the fact. I mean, if we couldn't set it up after the fact, just get it this way, then nobody would have a trust, because everybody makes the mistake of doing it before they get a trust. It doesn't really matter, to be truthful. It's just for privacy. I mean, honest truth, if anybody wants to find you, they can. I like to stress this. The purpose of a trust is to transition assets without having to go to probate, without having to go through legal fees. That's what the trust is for. It creates privacy and it transitions assets. If you don't have one, that's not the end of the world. It doesn't cost you any more taxes, and it may cause a few headaches if you pass away, but that's about it. So don't think about trust as some structure that's going to protect you from, the boogeyman. It's not that way, okay? Just know privacy is good. That's what a trust is for. But the privacy that you get can always be compromised, because I can search anything, anywhere, anytime to find anyone. Just remember that. It's like there's no privacy in the world anymore. I mean, if I wanted to find your social security number, I probably could if I Googled it really well. Just to be clear. Good question, though. Any other ones? All right, cool. For those of you here live on YouTube, thank you so much for watching this. If you're not on YouTube and you're watching this through Facebook, please go over to YouTube, like and subscribe to the channel. I do these every Wednesday for a reason, right? I meet with my clients every single day, and I break down the tax strategies. Which camera am I looking at? Okay. Every day I meet with clients and I explain these strategies to them and so much more. I'm pushing on them, right? Like at our boot camp. So we have a boot camp coming up, and we do one we may not do it the fourth quarter, but we have one upcoming. And when I go to the boot camp, this is what we teach. I'm like, okay, guys, let's bring your scenarios, right? And so what we do is we bring it in and we say, okay, there's the 500,000 minus the 100,000 for down payment. By the way, I should have illustrated here. At the boot camp, I would do this really big, right? I'd say, look, you had to invest 100 to save 34. So imagine what you really are paying for this property is $66,000. I should have illustrated that. You're paying $66,000 to own a $500,000 piece of assets. So it's incredible for me to say, hey, this is the easiest way to build wealth. The government subsidized. They do it I hate to say this, they do it for a lot of people. Why wouldn't they do it for us, right? You get it? Like, subsidized your down payment. That's great. Why not do this every single day? Now, when you get into the rental strategy, right? Let's go to rentals now. So now that we understand this, okay, and we understand that we can't just make money. You have to play the game right. You have to get cash flow. But here's the tax savings, right? So the tax savings comes from rentals when we really understand how to offset our income. So for an example, let's use a rental that's bringing in $2,000 a month, right? So we get $2,000 a month. If you multiply that times 12 months, you're going to get $24,000 a year. Now, out of that $24,000 a year, you've got to subtract expenses, okay? I'm going to give you some of the normal expenses, right? We said $400 a month for taxes for us, so 400 times 12 is $4,800, right? So $4,800. Now, in addition to that, we got to minus insurance. And let's say that one's $300 a month, so that's $3,600. Let's assume that we have 10% of that for maintenance and repairs. So let's say $2,400, right? So all of this right here, let's just make sure we do the math right. So we get 24,000 minus 4,800 minus 3,600 minus 2,400. You're netting $13,200. Now, remember, this is what you call net operating. So this is gross income. This is net income, net operating income. They call it NOI in the tax in the the real estate space. Now, just I want you to know this. This sounds really sexy right now. You're like, I made 13,000 off of that house. It's great, right? It could be. The real reason it's not so sexy is because remember, there's a mortgage tied to this. This is just gross income with gross expenses. You probably, to be honest truth, what if what if it's already $2,000 a month just to cover the mortgage, insurance, and taxes? Now you're negative 13,000 already. You see what I'm saying? And most people don't know this. Here's a big idea, big shocker. You can't deduct mortgage payments on your tax return. So don't ever get confused that a mortgage payment is going to get deducted from your taxes. That's called equity, and it's built into the property. So every time you make a payment, you're building equity. So the IRS isn't going to give you a deduction because you're building equity in your property every time you make the payment. Payments are not deductible. I actually had a client just this past week, came on a call with me, wanted to work with us, and he's like, hey, David, I want to know why I paid taxes on this rental property that I got. And I said, okay, well, let's look at it. So we looked at the K1, I reviewed, and I saw that he had $44,000 in income. And he's like, but David, I look at my bank account. There's no money in there. And I said, well, what do you mean there's no money? He's like, yeah, man, this thing says, because it was somebody prepared it for him. This thing says I made 44,000, but I don't have any money. And I said, okay, well, why don't you have any money? He's like, well, I don't know, but I can't report 44,000 in income with no money, right? And he goes, this guy must be stupid who filed my taxes. And I said, oh, well, do you have a mortgage on there? He said, yeah. I said, okay, how much is the mortgage? He's like 3,000 a month, something a month. I said, okay, well then that's probably where the cash went. 3,000 times 12, 36,000. And he said 3,000 and change. Let's just round it, a little more. I said, that's all the cash. And I swear on the call with this guy, he looked at me like, oh shit, I guess I'm an idiot. And I said, don't worry, most people think this way, right? Most people investing in real estate think that they can deduct everything. Mortgage payments cannot be deducted. Insurance, taxes, repairs, maintenance, those things can. So good thoughts. Any questions we got?
Yes, sir.
Go ahead.
If you're in the top tax bracket, is it possible to create a net loss via a rental property to reduce your excess tax bill? Or are these restrictions as you move up the bracket? Also, is owning a rental property in an LLC or other businesses better than a trust?
Perfect. So first and foremost, let's address the losses. So in order to get real estate, let me come over here. In order to get real estate losses to offset any income, even at whatever bracket you are, you first have to understand what your limitations are. Those limitations are typically capped at a formula of your AGI or $25,000, whichever it phases out. So I don't want to go into technicalities. Just know if you make a lot of money and you aren't a real estate professional, which I'll describe in just a minute, you have limitations anyways, so it wouldn't offset anything. In order for your income to be offset, and then there is a passive activity loss limitation of like 500 and something thousand. I can't remember the number, but 500K. Let's use 500K and 250K. Single 250, married 500 and something K, or 250 or 280. I think it's 280. Yeah, I think it's 280 single and some 590 or 580 for married. I hate to get. We can Google this. Don't fact check me, bro. Somewhere in that neighborhood. But anyways, you have a passive activity loss limitation anyways, even if you are a real estate professional. However, in order for you to even benefit from the losses of real estate, you have to first and foremost become a real estate professional. So I guess first think about it this way. Most of us would want to buy real estate to do two things: to not pay taxes, right? Number one, and to get cash flow. When we get our taxes done, we have to file a tax return that we have real estate. Now, on that tax return, we have to tell the IRS that we meet criteria to utilize that real estate loss if there is one, which there will be in the scenario over here. We'll lose some money. But the only way that we can do that is by actually claiming the real estate professional status, which is the ability for me to offset my income with my losses. That means you have to manage and maintain your own real estate properties for 750 hours in a given year. Remember that, 750 per property, 750 per property. Now, you may get some hours credited to you if you're in certain professions, like if you already are a realtor or you're a mortgage broker or you're a construction worker, you rehab and remodel, you may get credits for hours, But remember, it's $750 per property unless you group them, which could be a little more confusing today, but just know that. So many people would say, well, I am a real estate professional. I have a long-term rental. I have one long-term rental and I work 750 hours. I'm like, first off, if you got a long-term rental and you work 750 hours, that's 15 hours a week. What are you doing? Right? It's not possible. Number two, in order for you to meet the criteria, in addition to the 750, if you have other sources of income, any other income, you have to justify that you're doing real estate more than half of the time. So some people are like, well, I own a company and I'm a business owner, but I'm also a real estate professional. I'm like, well, which one do you do more of? Well, the company. Well, then you don't qualify. So you got to do the 750. You got to have more than half of your time done in the real estate activity. It's a big deal. It's a hard deal to do. So most high income earners just can't do it. It's just not possible. So your losses are limited to your ability to become a real estate professional. And number two, to the passive activity losses that are capped at about 500,000 if you're married, 250 if you're single. Those are the limitations to this. Now, to get to the second question, which is how would I structure LLCs and things of that nature? First off, I'm not a lawyer. However, I'm going to tell you tax benefits. Number one, I would purchase a property in an LLC and I would put that LLC single member or partnership. And the reason being is because you don't want an S corp or a sole proprietor, S corp or C corp. The taxation would be a nightmare in the future. You don't necessarily want to. You don't want to leave yourself open-ended to this. So be prepared to have an LLC per property. Keeps accounting good, keeps the structure good. Make sure that you don't commingle S corp, C corp stuff. So I hope that answered those two questions. Any questions online? Yeah.
Yeah.
Go ahead.
I did a cost segregation with a company that offered a computer-generated analysis, but my accountant won't accept it unless it's a full cost segregation. I'm confused. Should I change accountants or will it be the same?
Well, first off, stop being cheap and get a real cost seg. That's number one. Hey, your accountant, by the way, your accountant's responsibility is to make sure that the information that goes on a tax return is accurate. Okay. If he does not or she does not feel that the information that you're providing to them is accurate, they are responsible for entering it onto the return. So they should then not file it. So you can change your CPA. I don't see why not, but I would just tell you, don't be cheap, bro. The reason you got it done by a computer is because you're cheap. I mean, stop being cheap. I hate to call you cheap, but you're being cheap. Anyway, stop being cheap. All right, next one.
From growth, how can I attend one of your real estate courses?
Oh man, if you want to come to our upcoming boot camp, we have one on September 20th and 21st, Dallas, Texas. We'll put the link in there after the video, so we'll comment, DM you. I'll DM you directly so you could get that link. This is gonna be a fun event. Like I break down this stuff for 2 days. Like 2 days, I'm gonna break down tax strategies as it relates to real estate. From how do you acquire real estate using tax strategies? How do you leverage real estate once you own it? How do you sell it, transition it to the next property without paying capital gains? How do you Airbnb? How do you get a land acquisition? How do you grow and scale your portfolio? How do you get into big syndications? How do you become part of multifamily projects? And everything in between. It's going to be a great event. September 20th and 21st, Dallas, Texas. You can grab tickets. I'll send you those, but you can also go to my website, david8pettis.com. Go to the events tab and you'll see it there. It's going to be a killer event. So that's how you get to that one. Good question. Any others? Good. All right, cool. Okay, so I'm going to go for just a few more minutes. So if you all have questions, please enter them into the chat. And guys, team, you all can let me know, okay? All right, so back to the strategy, right? So we're going to do another 500,000, right? I just want you guys to get this. We're going to show you the illustration of a cost seg, okay? So cost segregation. So right now, just so you know, we're going to use something called depreciation. So depreciation is the method by which the IRS allows us to reduce the investment in an asset over the course of time, reduce the cost of the investment over time. We all know that things aren't worth what they were yesterday, right? So every day things depreciate, right? Very few things appreciate technically. Now, we know because of market conditions, real estate probably can, but the IRS has a rule. And the rule says that everything is depreciable, meaning everything has a useful life. There is going to be a time where things aren't useful to you as a business owner. Because real estate is a investment, this is why they created depreciation. Now, depreciation, again, is an asset that is broken up over time in its useful life. So for real estate, so this is RE depreciation, right? For residential, it's 27 and a half. And for commercial, it's 39. Okay. Now, why is this important to know? Just because if you don't know this, and what will happen is you may do this wrong. So what happens is you get 27 and a half years to depreciate your $500,000 piece of real estate. Now, the only caveat is that you cannot depreciate land. Okay, you can't depreciate land. So I'm going to subtract, I'm just going to guess 50,000 for the lot. So we have 450,000, right? So I'm going to subtract the 50,000. That's for the land, and I got 450,000. Now, what I want to do, if I want to use depreciation, which I'm supposed to, is I get the 450,000, and I divide that by 27.5, and I get $16,000 in a deduction every year, right? At this $27,000, 363. This is what I get as a deduction every single year. So that deduction is always going to come to me, guys. I want you to know this. That deduction is going to come to me no matter what. So if I have other deductions like real estate taxes or insurance, like I illustrated earlier, it just makes my property go negative and negative. This is how you take loss. Remember, we said $4,800 for taxes. We said $3,600 for insurance, right? So we are already taking loss after loss. And we can even add 10% of the property, not percent of the property, usually of the income. Let's say $2,000. Let's say another $2,400 for repairs, right? So if we do this math, we get the 16,000 minus 4,800 minus 3,600 minus 2,400. We got whoa. Yeah. Actually, I'm supposed to add it up. I'm stupid. 16,363 plus 4,800 plus 3,600 plus 2,400. I have $27,000 in deductions for this property in 1 year. And it's all attributed, most of it is attributed to depreciation. So the interesting thing here, if I would have gotten, let's say, $2,000 a month for this property, right? And I had it for 12 months, right? So that means I've got $24,000 like we used in the example earlier, right? So now I have 24,000, but if I subtract this 27, I've got 3,100 and I've got a negative $3,163. Think about that. I lost money on this property because of depreciation. So that means this 16,000 the IRS gave me is tax-free, meaning I get to use it. Now the cool thing is now that I lost money, this 3,000, I don't really get to keep it because I probably have a mortgage. I'm using it towards my mortgage and I don't have to pay any taxes on it. So it's actually a good thing. So real estate depreciation is normally 27 and a half. Now you can accelerate it, which means make it go faster by doing something called a cost segregation, which our viewer just talked about. Now a cost seg, what it does is it takes this 27 and a half years and it brings it over here and it brings it into 5, 7, 10, and 15 years. These are in years, right? So what they're saying is you could take your depreciation faster. Now, typically these three together, the 5, 7, and 10, those typically take 25%. So what happens is instead of taking the 450 divided by 27 and a half, we do the 450,000 times 25%. That's 112,000. Remember, that's what we used earlier, $500. This is what we get instead of the 16,000. You see how I basically almost 10x that? I didn't almost 10x. That's crazy. It I guess 8x, 7x it. I 7x my deduction just by using a cost segregation study. Now, that same deduction, I take the 112 and I take the 48, right? And I take the 36 and I take the 24, just like I would have normally done anyways. Think about that. So I get the 4,800, and I take the 3,600, and then I take the 2,400, and I've got $123,300 in a deduction. Look at that, man. I take $123,000 deduction in year one. So if I would have had income of, let's say, $150,000 from my W-2, that would have offset almost all of it. I'd only have $30,000 of taxable income. My income would go significantly down. Cost segregation is the acceleration of a depreciating asset, specifically to real estate. So I hope this helps. Any questions came up? Or any?
Somebody said, how do I engage your team for planning my tax?
Perfect. Good question. If you would like to work with us, you can go to taxplanexperts.com and schedule a free discovery call. Taxplanexperts.com, schedule a free discovery call, or come to one of our boot camps. I'm telling you, the boot camp coming up, the real estate tax strategy boot camp, is probably the coolest boot camp you'll ever go to. I don't like to brag, but let me just say this. You can go to any real estate boot camp. There's tons out there, right? Every guru or whatever has a boot camp to go to. None of them know taxes. Every one of them is there to pitch you on something that they want you to do. Join my real estate coaching program or invest in my fund bullshit. All that stuff's stupid, okay? We're actually teaching stuff at our boot camp. We're actually breaking down tax strategies that it can impact you today so you don't make the bad mistakes that we've made in the past or some of my clients have. It is a real boot camp. And that's why when you go to the site, you'll realize that it's an investment. Well, going to something that's going to help change your business, change your investment strategy, and hopefully keep and grow your money, it's always worth investing, okay? So think about it that way. All right. If we don't have any more questions, I think we are done for today. What do you think? All right. So if you enjoyed this content and you really want more of it, go to my YouTube channel, subscribe. Please, I'm trying to grow my channel. I know, by the way, I know you got value out of this if you watch this, because I'm telling you, there's nobody teaching this stuff. Just no one. Nobody's out there kind of bringing out the real stuff, the real behind the scenes, behind the curtains. I just told you, by the way, why you shouldn't invest in real estate and why you should. Some people will just tell you should because they want you to do something with them. I'm not asking for anything. Just like my channel, I'm giving it away. My goal is to help and impact 5 million people in my lifetime, keep and grow their money, and I want you to be one of them. So if you like this stuff, please share, like, subscribe, okay? Share, like, and subscribe. If you have questions or want to know more about what we do, how we do it, or go to one of my boot camps, just comment in the chat here on YouTube, and we'll get right back to you guys. So as always, this has been fun. Every Wednesday at 12 p.m. CST, you can bring your lunch. Every live event just for you. If you have questions, need help, or anything, you're welcome to bring those questions to the live chat, just like we're doing today. And I look forward to seeing you next week, next Wednesday, on our live Building Wealth with David. We'll talk soon. Have a great day.